Hello, everybody, and welcome to the new SFI Not So Live, brought to you by SFI, so Saffron for Intermediaries. I'm joined, as usual, by Mr. Tony Hall. Tony, say hi.
Hello, everybody.
That's all the introduction he gets. He's here every month. And this time we've lost Holly. She's away. I don't think she's sunning herself. She's certainly got her feet up. So she's away for this month. So we are joined by Mr. Simon O'Donnell. Simon, say hello.
Hello.
And a little bit about you, Simon, just for the listeners' benefit. Tell us about you and then what your role is at Saffron.
So I'm Simon O'Donnell. I cover the South, field-based BDM for the South for brokers for Saffron for intermediaries.
Wonderful. And we are blessed with two special guests this month, which is an unusual one. We don't do one, but we've got the two. So I'm going to let them do little introductions. You've got a little minute introduction each here, guys. We'll start with Nathan Riley. Do you want to introduce yourself, explain who you are, who you work for, and just tell the audience a little bit about you, please?
Yeah, no worries. So Nathan Riley, Director of Lender Relationships at 27 Tech. My role at 27 Tech is to work with our 100 plus lender partners to make sure they're getting what they need from our technology and our service ultimately, but also working with lenders like Saffron to try and identify new opportunities from a transformation perspective to ultimately try and move our market forward for intermediaries.
Amazing. Thank you, Nathan. And over to Alex. Alex Beavers, say hello, introduce yourself and tell us a little bit about what you do.
Hello, Alex Beavis, Proposition Director for Mortgages and Later Life at Sesame Bancorp Group. I'm still relatively new, SBG, been in about 4 or 5 months. My role is to look right across both PMS and Sesame within the SBG network and build value for brokers and advisors. So looking at the relationships we have with tech, with lenders, with marketing, and with other distribution to try and build more value in for clients and brokers in the proposition.
Great stuff. And the guys have been carefully chosen, actually, because we have a little bit of a theme on this podcast. We're going to be talking a little bit about technology. They're both looking a bit like, have we qualified? No, I'm joking. We're not going to go into too much detail, but we thought we'd have a little bit of a technology focus this time, just something a bit different. We're looking at news, but we'll also be starting off, as we always do, with some topical news stories that affect the property and mortgage market. And it's been a bit of a couple of weeks, really, with the autumn budgets now out. A few things have changed. Not a huge amount of benefit across the property sector when you pick at it, but we will pick up on some of those. But first story of the day, something we all didn't really want to see, but certainly not if you're a new buyer. But nationwide house price report is out, and the prices are up yet again. And we've surpassed £250,000 average house price cost, which, perhaps might not be overly surprising the way it's been creeping up during the pandemic. But what does this mean now? Tony, I'm going to come to you first and bully you in. What does this mean, especially for first-time buyers? This is not necessarily a good thing, right?
No, I suppose that the more expensive the houses, the more expensive the mortgages, because you've got to have a bigger loan, and that with the rate rises already being seen from lenders anticipating a change in the bank rate, which is probably going to happen early next year. Now, I think they're saying it's only going to get more challenging for them. I think the other challenging thing for first-time buyers is lack of housing stock. We're certainly seeing it. We've got a lot of activity sat there waiting because they haven't got a property. So they've done a decision in principle with us, and we've said yes to them as the person, but they haven't got a house to proceed with. So it is a bit of a logjam at the moment. So and obviously it's interesting. House prices rising and rising. There's going to be a point where they won't, because that's every market and every cycle does that. But it doesn't show any signs of doing it yet. I think we've still probably got a bit of the halo effect of the stamp duty holiday and people off the tail of that. So I think that will kind of wane over a while. But yeah, interesting time. Interesting
you said, I thought stamp duty holiday's done it, and this is obviously the log jam that's come afterwards, but it's still continuing. So is the demand for housing still really strong across the market? Alex, Nathan, anyone's got a comment, but what's your opinion on this growing cost of homes?
Do you want to take it, Alex? So then I can just turn around after and say I agree with you.
Yeah, all right. I think it's a double-edged sword. So as covered, first-time buyers, it's an absolute nightmare. And actually, the stamp duty changes, while they were broadly good for the market, didn't really help first-time buyers, because what you've seen, that underneath that kind of 250,000 headline is that house prices are up 10% year on year, and wages, although we're running high on inflation, wages are more like between 4 and 5% up. So that affordability challenge is twice as twice as hard as it was before, and that's from a difficult starting point. However, on the other side, we're just about to go into an absolute bumper season of product maturities. So we've got more borrowers coming to the end of existing deals next year, than I think for at least 10 years in the market. And what rising house prices means is a lot of those would have moved down considerably in terms of LTV brackets. So a lot of those customers, those clients, are going to be able to save quite significant sums of money. So if you've gone on at 90 on a 5-year fix, it's quite likely you're going into a 60% deal. So although there's been a lot of talk recently about rising rates, I think offsetting that is the fact that the increased house prices should mean that a lot of remortgagers and product transfer customers get a better deal next year.
Yeah.
Do you agree with that, Nathan? You want to add a two pennies worth in there? Is that your viewpoint, too?
There's probably a few things I wanted to pick up on off the back of what Tony and Alex have both said. So one is definitely stock. So Tony mentioned that the government keep coming out and reinforcing that they want to invest in more houses to try and manage this issue and to try and make getting onto the ladder easier. But we haven't actually seen them hit that target yet, I think it's fair to say. And also, we're also not getting a huge amount of clarity in terms of the type of properties they're looking to build. So everyone's seeing similar developments going up where you've kind of got your 3 beds or your 4 beds, detached, semi-detached properties that fit a certain customer, but certainly not every customer. And I think there needs to be a bit more of a strategy to look at certain pockets of the market. So what are we doing for first-time buyers to build more affordable housing for them? But something that's often missed is the downsizers. What are we doing to build suitable and appropriate properties for downsizers to try and keep that chain progressing? Because right now, a lot of stock is actually sat with people that don't need that space. So I think certainly a strategy in terms of the properties we're building is a key focus. Also, we've kind of touched on rates a little bit already. Do I see demand dropping dramatically? Probably not, because if you look at the rates out there, it's still a good time to buy from a rate perspective, particularly if you look at the national press and all the sub 1% rates they're reporting. So if you're a consumer, it feels natural that you want to go out and see what's available to you, particularly if you feel like you're struggling for space off the back of the pandemic and you need that home office. So we've seen in our data that purchase activities have tapered a little bit, but they're still up on pre-COVID levels. I think the challenge that intermediaries face now is exactly what Alex said. We've got still a very buoyant purchase market, but an incredibly busy Remo and PT market that's only going to go in one direction as well.
No, I agree, and it's interesting you brought up the government's activities actually, because I agree with you that the strategy is a bit lame and nobody really knows what they're planning to do. But Tony, coming to you for a moment, I know it's not your department, but worked a lot in development finance and trying to get small developers who can produce 3-4 homes that are affordable. As exactly as Nathan's saying, it will suit downsizers or suit first-time buyers or suit the smaller purchasers. But actually, they're promising this brownfield land, but it's not coming to fruition. So actually, the developers aren't getting the land they need to build on. So is that an answer? Can local councils fix some of this problem?
Well, yeah, but it's like anything within government or local government. Nothing is easy and nothing is quick. So you've got to. It's very easy to make a corporate statement. It's not so easy to back it up. So I think the intent's there, but unfortunately, the impact of trying to make it happen is slightly different. I think one of the other major factors at the moment affecting the whole house building is the supply issues in terms of physical supply stuff. I've been talking to a lot of builders and throughout the service industries are like, we've stopped doing stuff because we just cannot get hold of stock. So that is going to impact as well, and it's, if you look around you, every single road you go down will have at least one or two extensions going on at the moment. Yeah. So you've not only got that and limiting supply, but you've also got then the people trying to build houses with, and the big guys will try and get all the stock first because they can, because of scale. So it's a challenging time. It is a challenging time, but it's been a challenge since 1979 because we've never hit our quota of house building since that date. So it's not a new problem, but it won't be solved easily. So I think ultimately, it is what it is, and it will get there eventually.
I think we just need to hold on to our optimism and hope that things are going to improve. Obviously, we've had a pandemic. We don't know, we don't know what the effects, long-term effects of that are, but certainly the short-term effects are kicking us quite hard. So,
yeah. Well, look, the improvement is houses aren't going down in value. If we had that as significantly, there's a bigger problem. So, we should look at it on the bright side, as you say.
Yeah, and I think.
Do you want a cheeky prediction?
Sorry, Alex, carry on.
Do you want a cheeky prediction on house prices for next year? By no means scientific, but I think we'll move back down closer to the sort of normal long run average of house price increases. So I think next year more like 2 to 3, maybe 4% up year on year. But within that, a lot of regional variation, sort of picking up on Nathan's point. So one thing we don't really know yet is how much of the kind of COVID related behaviors, race for space, movement out of cities, reduction in demand for flats, but increase in demand for 2 beds, 3 beds with a home office and a garden, how much of that will continue? So I would suspect that next year we'll either see that crystallize or some of it start to ebb back to where it was before. I think some of it will stay. I think people won't go back to working in the office 5 days a week. People will want a home office, and therefore the way they live and work will have changed, I think, forever, and that will be reflected in house prices. So flats, particularly in less desirable regions, may be down a bit next year, but 2, 3, 4 bed houses on the fringes of cities, I think, up. So we'll see.
Nathan, sorry, you going to say something?
Yeah, I was just going to link back round to Alex's point around affordability. I think affordability is a huge challenge, but the one thing I would say to give intermediaries some reassurance is there are new players coming to market that want to work with lenders to help them overcome that challenge. I don't think we've seen them en masse yet, and it'll be interesting to see where the lenders truly have the appetite to work with them. But I think going into next year, you'll see more announcements regarding these third parties and potential strategic relationships being established.
The end of Help to Buy will really light a fire under that. So most of Help to Buy is now forward sold right to the end of the scheme because the big developers, they are selling a year to 18 months ahead of build out dates. So really, if you haven't got yourself a Help to Buy, you're probably not going to get one now. So what that will do is create a big hole in the mortgage market, particularly for first time buyers, but also for second steppers in terms of that scheme. What was great about Help to Buy is, it had some flaws, and we could have that debate another time. But what it did do is it helped borrowers with affordability and deposit, because you got a big 20% chunk from the government, which therefore meant you got a cheaper mortgage rate, which made it more affordable. There isn't a direct replacement for that, and as Nath said, there are a lot of private schemes that are coming to the market, and some of them are very good, but as yet nothing has kind of come to the fore as an obvious replacement for Help to Buy, and we're gonna have to see how that goes next year, but I just expect to see quite a lot more activity.
Brilliant. Okay, we'll long chat about that one. Something that everyone was a bit passionate about. So on to the next one. And Simon, you might actually get to speak this time. Sorry, mate. So we're moving on to the self-employed. Tony and I probably talk about self-employed at least 3 times a week and on everything we possibly do, because it has been a particularly hard time during the pandemic for self-employed. A lot of them didn't get the support that they needed. They might have made the slip up of taking out, supporting grants, etc. But the new piece of research, the only reason I brought this one in, new piece of research in Mortgage Introducer from a home loan provider, not not going to name names, has researched with some homeowners, and 100%, well, 100 of self-employed people, sorry, that they discussed, saying they're still finding it particularly difficult to get a mortgage. Now, we know this is an issue. We've addressed it on other things we've done now, but for a self-employed person, is it really, Alex and Nathan, I'm coming to you because we've got our own opinion on this, but coming to you guys, and then we'll come to Simon and Tony in a minute, but is it really that difficult for a self-employed person to get a mortgage now we're outside of the major effects of the pandemic?
It's a lot easier than it was, and I think most lenders have walked back on a lot of the policy restrictions that they had to implement during COVID. I think you need to use lenders that will take a common sense of view on each case. So with self-employed, yeah, every set of circumstances is different, and what good underwriting will do is take a view on that depending on the story. And actually, what I would hope to see is some real common sense. So, yes, what happened in last year happened, but is this person still trading now? What does their business outlook look like for the last couple of months, and what do their forward sales look like, or what contracts have they got in place for the next 12 months? Because if we take the kind of historic view, SA 302s, and what does your last 2 years look like for everyone, and particularly people in the self-employed, that might not look that pretty. But actually, as we know, the economy has rebounded well. A lot of people are now busier than they've ever been before. So what my ask is, and what I think advisors would want, and certainly what clients want, is lenders to help them with a common sense view based on how their business is performing right now.
Thanks, Alex. Nathan, just coming to you before I move to the guys from Saffron, but what are your thoughts on it?
It's a really interesting one. What the article doesn't say that we're kind of talking around here is whether this perception from self-employed customers is there purely as a result of COVID or whether it's long-standing. Because year after year, a piece of research tends to come out like this, which for me shows that it's not just COVID related. So for me personally, I think it's more around education and overcoming that perception that self-employed customers have. And I think it probably dates back to the recession and the difficulties they had there. Because when you anecdotally speak to someone that's self-employed, anywhere in the street, we probably all know them, they'll go, is it going to be hard to get a mortgage? I found it really difficult 10 years ago. And I don't think we've necessarily overcome that negativity yet. So I think it's down to intermediaries, lenders to get that message out to self-employed customers to say the market is open for you. Whether you're employed or self-employed, it's actually broadly the same, but use an advisor because they will be able to work across a panel of lender where there'll be more solutions for you that maybe the high street can't offer.
Good, very good point. And actually,
very, very nicely there, Tony. By the way,
I'm going to go to Simon on first. Actually, before you get to plug Tony, I'm going to Simon first. But just on something you picked up on, Nathan, I agree with you in the piece of research because I see it every year. But what was really interesting here was the big moan from these self-employed people that were researched was the fact that there weren't enough lenders. And I was like, well, you are self-employed is a little bit specific. And so, yeah, so I agree with you. I think when you pick at it...
You only need one lender, to be fair.
Here he goes. On the plug already. Right, I'm just going to go to Simon. Simon, for the self-employed, there's self-employed specialist products. So, if you haven't got 3 years' worth of accounts, you can't go on a typical mortgage. There are self-employed specialist mortgages. Surely that fixes this problem a little bit, doesn't it?
Yeah, I think at Saffron, even pre-pandemic, we've always been a big advocate for self-employed applicants and try to do what we can. And, I take Nathan's point around not just the pandemic, perhaps that perception of how difficult it is to get a mortgage as self-employed applicant. But, we never actually changed our policy throughout the whole pandemic in terms of self-employed. So I know a lot of the high street banks and some other lenders walked away from self-employed to a certain extent. We never moved. And to Alex's point around common sense approach and looking at the whole story, furloughed income or bounce back loans, government grants, etc., stuff like that, we still took views on all of them. And then more recently, we've actually taken more steps to help the self-employed. So 90% with 1 year's books will look at you. So if you've perhaps been made redundant during the pandemic last year, you've got a new vocation, you want to you've taken up self-employed and you've got 1 year's trading, we're happy to lend up to 90%, which are not too many lenders are in that market. And the other thing is, excuse me, the biggest plus for us is that we've now, underwriters have the discretion to discount 2020, 2021's trading year if the applicant's back trading at sort of pre-pandemic levels. So that's a really, really positive plus, and something actually we've seen a lot of interest in recently, and underwriters are abiding by the rules, and we are seeing a lot of these types of cases go through. So yeah, really, I'm slightly biased, but I think we've tried to do what we can for the self-employed. Yeah.
Well, since we're
I
in
genuinely didn't
bias
know that when I
mode,
made my point.
Tony, let's talk about
Well,
the recent
for the
policy
benefit
changes.
of
Come on, you might as well just get your plug in now. But no,
for
on
the
a serious
benefit
note,
of the viewers, I'm sulking. No, look, Simon's right. Saffron has a few lenders. There's not that many that has really been holding out a big candle for the self-employed, but it is a big area for us, and one that we want to explore further. It fits fully into our strategy, but also into our whole mutual ethos of helping people into homes. That's the whole point of mutuality. So it fits us really nicely. So I think one of the things we have seen since we've made the decision to discount the pandemic year is people trying to, if I'm honest, use the pandemic as an excuse to mask how a business is not performing. So we've kind of seen that in quite a few cases, and are taking a view on it. As we very clearly said, we will not be able to do this every time for people. We're very straightforward with that. If we can do it because it sees it, we will. But don't think we're just going to turn a blind eye to a business that's not solvent, or cannot afford this loan. So it's an interesting one. But look, we're here to help. The research is not a surprise. I think Nathan's right. This is an issue that's been going on for years. The self-employed, when it comes to mortgages, do find themselves, do feel sorry for themselves quite a bit in this market. The problem is, isn't it? You try and mask, and I can say this as an ex-contractor, and we all do this. You try and mask your true income in order to be as tax efficient as possible. Unfortunately, when that comes to getting a mortgage, you can't show the affordability. So it's a challenge, isn't it?
just going to quickly chuck a caveat out there. We're not encouraging anybody to do that.
No, edit this bit out, but I'm not saying that.
You're right.
That's why I said tax efficiency, not tax evasion. There's two different contexts to this. But that's always been the challenge of the self-employed, and particularly the contractor. And that's where the contractor policy came from, so that a contractor could actually borrow what they actually can afford, as opposed to a set of accounts that shows a lower figure for tax efficiency reasons. So, we're, you can probably edit most of this out, which you never do for me, but we're just here to help. We want to help, but we won't be able to help everybody. What I would say, the plea to brokers is, we always say, is tell us the story. Give us the reason why we should consider this swing in activity. And, the first question we ask everybody is this really as an impact of the pandemic? And then you start to get well, no, it's probably not. So sometimes it is, sometimes it isn't. So, but we're a straightforward lender, and it is all about common sense. We say that a lot, Jay, as you know. So if the story makes sense to us, then there's a great chance of us saying yes. If it doesn't, then we're not going to be able to support it just yet.
And it's the manual nature, isn't it? And it goes alongside the common sense approach is actually the manual underwriting, and somebody actually taking the time to really look at that story and really take a consideration of that person's situation, because everyone's different. So thanks for that, guys. Covered that one quite well as well. Just last of news stories, we want some more techie stuff, but for the sake of the listeners, we're in COP26 week. So we're going to move on to a little bit of a green subject. It's a subject that we also have covered recently, and how the government is exploring these green home improvements, and how that can have an effect on the environment. And I wanted to just tap on green finance a little bit, and picking apart what green finance is and whether or not it's greenwashing. So there you go, topical subject. But um, Alex and Nathan, you can choose who wants to go first on this. But is there really a growth? Is there really a strong interest in green financing when it comes to mortgages? Are you seeing this? Has COP made any effect? Is there suddenly like a load of brokers coming in going, oh, I've got clients that want a green mortgage? Or is there a level of we've got to have this and maybe it might grow in the future?
I'll give my one word answer and then Alex can pick up the detailed answer. From my perspective, no. Over to you, Alex.
I think it's maybe a bit more nuanced than that. But picking up your no, what we've largely seen in the mortgage industry so far is discounts for people on mortgages who are in the luxurious position of being able to afford energy efficient homes, and largely in the new build area. Does that is that a bad thing? No, not really. Does it help? No, not really, because it's not really changing behaviours. It's rewarding people who already can afford an energy efficient home. So the stat that I always chuck out there is housing in the UK, in the broadest sense, contributes about 28 to 29% of all of our CO2. So there's a lot to go out here, and it's going to take real concerted, joined up effort across the sector to really start making a difference. The barriers we've got, and I think this probably underpins a bit of Nathan's no as well, is at the minute it's just not cost effective to make energy improvements to your home. So taking out whether it's a further advance or whether it's an unsecured loan, you're looking at, depending on the numbers and your source, you're looking at somewhere between potentially 10 and 20 grand to move yourself up one EPC band rating. And that's even if you know what the EPC rating of your house is, which about half of people don't. So am I going to borrow 10 to 20 grand over 25 years to install a load of energy efficient improvements on my house? As much as I think that's the right thing to do, a lot of people, the finance doesn't quite make sense yet. So what we as an industry need to do is find a way of providing innovative financial solutions that let people benefit from green. Because whilst green still costs more, I think people won't do it, or they won't see the immediate transparent benefits of doing it. Because it's one thing to believe that ethically it's the right thing to do, but it's also got to line up with your wallet, and at the minute it just doesn't.
And
Thanks for defending my one word answer, Alex. Much appreciated. I was just going to add to defend myself as well. I think there's some quite significant challenges above and beyond what Alex has even mentioned. So on the consumer side, you've got the finances to actually make those changes, but you've also got the demand piece. When people are looking at their houses, are they putting how sustainable it is at the top of the priority list, or are they thinking about a new extension or improving their garden? I think there's been research that's come out in recent weeks showing that it isn't number one, and it isn't even close in some cases to number one on their list. So there's a disconnect between, I think, what government want to achieve. I think, in fairness to lenders, what lenders want to achieve, and ultimately what consumers are looking for from their properties. And as Alex said, I think the only way we can only really overcome that is through product innovation. And right now, that isn't there. If anything, my concern is the way that green products are being pitched to the market could create a two-pace market where you've got an inflation of house prices, where you've got an A to C rating, and then a potentially stagnation or a dip in prices for those that are below that banding, which goes back to all the challenges we mentioned previously surrounding house prices. And suddenly those people that are in A to C, that benefit that they should be actually attaining from being more efficient and potentially getting a cut on their interest rate, will be wiped out by the house price piece.
mm-hmm. It's interesting, isn't it? Because you both alluded to this, that our biggest problem is our housing stock is so old and so non-energy efficient that actually the focus needs to be on improvement of the homes that you're living in, not necessarily the home you're buying into. But actually, Simon, Tony, I don't know if you picked up on this on your green mortgage. The focus of that mortgage is a discount based on improving your EPC. So actually, it's an educational thing to say, if you know what your EPC rating is, you improve it, you get a discount. That's right, isn't it?
Yeah. Yeah, if you improve it to a minimum E rating within 6 months of completion, you get a 0.1% discount off your rate.
And that,
So it's encouraging those to make that step. And we are, you know, we I agree with Nathan that the green options at the moment are limited, and I think that's because there's been no real drive to do anything different, which I'll come on to. But our product's there to help those. As you said, it's not it's not rewarding those who are energy efficient now. It's those who want to. But consumers won't make this leap until they know what's in it for them. At the moment, I'll be looking at heat pumps this morning and the cost of heat pumps, right? Because my boiler's old and it's on its way out, so I want to do the right thing. But you're looking at about average of 8 grand to put in a heat pump, and then the actual ongoing cost of your bills isn't much different depending on the rating of your house. So actually, the heat pump costs you a lot of money, more than a normal boiler. It's the right thing to do environmentally, but economically, for my wallet, it makes zero difference.
to just pick up on that though, I've just come out of my window with my energy company, my fixed rate. So I had to pick a new rate. My electricity bill as a single man in a one-bedroom house on my own. I'm never here because I'm always working. My the bill that I'm averaging at the moment is £42 a month. My new rate, it's £81 a month for just my
Yeah,
electric. Okay, now I have got an efficient home. It's a new build. So
yeah,
if you live in an old house that is seeping out energy, your gas and electricity bills are going to go through the roof. As soon as your window's up and you come to get a new tariff, you're suddenly going to realise just how much these heating prices have gone up. I mean,
yeah, yeah.
I literally thought I'll move, but where do I go? I've got nowhere to go. So actually, could the energy prices kick consumers up the butt a little bit?
Well, I think they will. Definitely people will be looking for cheaper alternatives. I think what's going to drive the market is obviously the government talking about a lender's book having to have this average C rating, and that by its very nature will drive innovation into the market. But as the concerns are saying, it will also potentially drive a whole load more mortgage prisoners that cannot remortgage away because they can't afford to do the improvements to get themselves into a rating to be able to remortgage to a new lender. So I think there's pluses and minuses there, and we'll have to work those through. But Alex's point is the key thing. It costs a lot of money to be energy efficient, and then it takes a lot of years to pay that back. And right now, that connect is just not there for either side. So it is a real challenge.
Simon,
One thing we have.
right,
Oh, sorry, I was just going to say one thing we haven't talked about is helping the brokers with this as well. So sourcing systems, 27 Tech being one, we need to continue to innovate and transform our system to meet this growing demand. But then it's with distribution and lenders to make sure that technology is being engaged with. So we don't forget about green products, because there are some out there currently. And if you speak to some lenders, they've seen submissions where it should have been green, but it's just been missed. So,
right.
so we need to be better as an industry at promoting this as well a little bit more, I would say.
Simon,
There's no advice. Sorry, Simon, you will get
you'll get
to go.
the
But this just to picking up on Nate's point, there's nowhere to go for advice on sustainability and green. So your current mortgage advice process doesn't take into account um, weighing up the financial implications of investments in your property to make it more green against the costs that will cost you in terms of additional borrowing, minus the benefits you get from lower energy bills, and potentially your property being more desirable, and then having a higher house price should you want to remortgage or sell it. So one of the things that we're thinking about as a distribution is how will we support clients with that in the future, and support advisors to support clients, because yes, people are going to need to weigh up not only how much can I borrow and can I afford this property, but also within that, can I afford to improve this property, and what's that going to do to my overall income and expenditure over a longer time period as well. And that's not something that happens in the advice market at the minute.
And I'm going to be honest, it doesn't matter what market you're in. There's nothing for it. I'm an ESG specialist, and I can't even provide businesses with 100% of that at this stage because nobody knows. We're all a bit running away with ourselves, trying to find this green agenda as much as anything else, and the social agenda happened the pandemic. So I'm going to come to you because you're the youngest on the panel, and you've probably got younger friends than we've got, perhaps, but. Do you think generationally this matters more to the young people than it does those of us that currently have a home and perhaps we're perhaps locked into it? Do you think the youngsters are more driven towards greener options?
I think in theory they are, but obviously purchasing a property is one of the most expensive things you do ever. So when if you were buying something for £100 and if you pay a little bit more, it's greener, you might be more inclined to do it. But when you're spending £2, 3, 4, £500,000, it really does test that. Oh, do I want to be green, or like you say earlier, do I want that conservatory? Do I want that extension? And prior to us having a chat, I was looking at some stats, and 94% of brokers have yet to sell a green mortgage, which I think tells a massive picture in itself. That only 6% of brokers, albeit polled in this survey, which would have been a minute few. Only 6% have sold a green mortgage, so I think it's going to check some shifting in rates. And my understanding is that Europe are a little bit further ahead in terms of there's more significant difference in rates for greener properties. Yeah. So I think ultimately there's a few things that we need to do, and that's probably one of them. Is to make it more, because you're looking at 0.1 difference to spend money to get your property up that EPC rating. But if you weigh up the two, then
you have to look at long-term budgeting, I suppose. But Tony, I know you've had to talk, but just quickly, something Simon said, us being behind the rest of the world, actually, we're pretty much ahead compared to a lot of people. But actually, when you look at Scandinavia, I think forgive me if I'm wrong, but I think it's Sweden or somewhere like that, where actually when you took out a mortgage, you took out a lump that would improve your home by introducing a heat pump. You spoke about heat pumps. So now they've got 67% of homes with heat pumps. So do you think that's the future? Do you think there's a way we can change our products to include some kind of agreement? Is there something we can
do? I think you've got blue sky horizon, for lenders to really be brave and think and look at partnerships and look at affinities that do that. I think, and as I said, I think with what's coming down the line in terms of a lender having to have a C rating, it is going to drive this thought process, and it's one thing that we're already looking at. The last part I just want to make on this, I'm conscious of our other things, is one of the other issues affecting the green agenda is modern methods of construction and lenders' ability or inability to accept that there are other things rather than bricks and tile. A shameless plug for us, because we're probably one of the...
I was going to ask Tony, do you accept MMC?
Exactly, Nathan. Exactly. You do. Funny you should mention that, but it is something that... Yeah. Well, hello, it is my podcast.
Actually, it's mine.
It is, yeah. Who pays your retainer? Yeah. So... that is a key thing that stops a lot of green construction, is the fact that only certain lenders will accept certain methods of construction. I'll get this, provided it's BPE, BOPAS or BRE accredited, we're quite comfortable with whatever material that is. So I think that's another thing that's got to get broader, that the surveying industry as a whole has got to step outside of the 19th, 20th century doctrine of brick and tile and consider the future. It's a challenge because they've got to look at the sustainability of these materials when valuing a house. So I understand the dilemma they've got, but that's what's going to escalate green, is far more energy efficient homes being built with the right materials, and the materials that are being supplied that aren't creating a massive carbon footprint to supply them. So we've got to look at all that as well.
Okay, I'm going to do a blatant plug for Saffron a little bit here. It's editorial though, so guys, you can't take the mickey out of me. But I'm currently working on this looking at the partnership options and what's happening around the world as an article. So that will be available in the next couple of weeks. So we're looking at what other people are doing and where the UK could take their market. So that is on its way. So I'll be working with Tony on that. But we're doing our research on a global scale to have a look, which beautifully takes me on to the next story, which is over from America. It's in Forbes magazine. Probably not something everybody reads that's listening to this podcast, but it's talking about technology in mortgages. And the reason I picked on this article is not actually so much for the content, it's more to do with the context. In Are we developing technology quick enough in this country, or are we behind the rest of the world when it comes to mortgages? We've got more conveyancing systems that are online. We've got guys like yourselves who are, more online technology than ever before. But is it moving quick enough? Are we modernizing the mortgage and the property system, the whole system? Are we improving it quick enough? And what more could be done? Nathan, I'm going to come to you first.
You can't get away with a one-word answer
Yeah,
here, Nate.
no,
No, I
You might
can't
for a
ever
mortgage
really.
tech provider.
Are we doing it quick enough? Selfishly, probably not. Are we doing it quicker than we were pre-pandemic? Definitely. But I think that's through market pressure rather than people necessarily wanting to prioritize it. So I think there's a disconnect in the fact that there's a perception, maybe within some lenders, some operations, that technology isn't really needed in this industry, but ultimately they've been pushed on because that is what customers are expecting. And every technology strategy should be customer driven. So if that's what you're being asked for, you need to keep up with that speed. So much better than we were. I think that there's still a long way to go, in all honesty. And the big challenge we face in this industry is there's a huge amount of documentation that still flies around. We still like a piece of paper and pen too often. We need to find a way to get that information into platforms, into systems, so then it can be passed across to other platforms and systems. That's one thing. The other thing is, as an industry, we're burdened by a huge amount of legacy technology. And I think for some of the biggest lenders out there in the market, that is a huge challenge because those systems have been accumulated over years and years, and they're core parts of what they do. So how do they upgrade them so they are in a sufficient state where they are moving into modern times without completely tearing apart their business in the interim? And I don't think lenders have necessarily got their heads around that yet. But positively, it is good to see, I would say, some of the challenger banks and some of the bigger societies, which Alex will probably talk about, starting to take on that challenge where they aren't necessarily so much burdened by legacy, because someone needs to trailblaze this and move it forward, because otherwise we'll just stay where we are.
He queued you up there, Alex. So, Alex, you
It
want to carry
did.
on that conversation?
I think it's a really good answer. I think we've had a tendency in the mortgage industry to massively overestimate the pace of change in the short term, but I reckon we've probably underestimated the pace of change in the long term. So if you think about where the mortgage industry will be in 10 years' time, I think it'll probably blow people's minds.
Mhm.
And I can fully foresee a world where you can get a mortgage by holding your phone up and looking at scanning in a picture of the property, and you can get pre-approved and get finance there and then. But we've probably over egged where we thought we'd be. We've been talking about APIs in the mortgage industry for 5 years, and yet we've not really got to the point where there's critical mass in terms of APIs for straightforward things like DIP and app and case submission. Although we are getting there now, and I think the majority of the larger lenders in the market are there. The second tier are catching up, and then you've got a lot of challengers and smaller societies looking at what they can do as well. The problem we've got, which is one that Nathan pulled out, is the mortgage industry is quite unusual in that it's really, really compartmentalized. So everyone owns a little bit of the journey along the way, from broker and distribution, lender, conveyancer, surveying, GI, even things like protection and wills and removals. There are so many different businesses that are involved in getting a borrower from how much can I borrow, can I buy that house over there, to I'm moved in, and lining it all up is a real logistical challenge. And as Nate said, it's like rebuilding a ship while it's still at float. We can't throw it all out and start from the ground up and build a whole new system. We've got to try and do it incrementally as we go. So I think a lot of progress has been made, particularly in the last 12 months when COVID lit a fire under it and things couldn't happen in the traditional way. So businesses have been forced to think about, well, what can I do digitally? And that has accelerated the pace of change. But yeah, there is a long way to go, because how long does the average house purchase still takes months and months and months. How in the modern world, what else do you wait for that takes months and months and months? Not much. So if you compare our industry to buying things on Amazon, we've got a long way to go before that gap is closed.
But Simon, I'm going to come to you again. Sorry to keep picking on your age, but with young people who are born with a dummy in their mouth and a mobile in the hand, the Gen Zs of this world, it's an expectation that technology exists. I work in multiple sectors, not just in this sector. I work in multiple sectors, and it's an expectation that you have a technological way of doing something. Like even a vet practice, they want to be able to book on an app rather than phoning up. And if their pet's in hospital, they want a picture on their mobile as opposed to a telephone call. So it's really going to be, there's going to be a generation coming through, Simon. It's going to have an expectation for technology, surely.
Absolutely, and I think it's been mastered a little bit with Zoom, and Teams calls can be done online now, and it'd be interesting to see the next generation coming through, because even myself and my generation, we expect the mortgage process takes months, we just know it, but actually those that are coming through now that haven't got a clue are just going to expect it within weeks or perhaps a month. So if it's a particularly long case or complicated and having to wait 6 months to get a mortgage or something like that, I'd be interested to see the expectations and how quick it gets going forward. So yeah, definitely.
That raises.
I
was going to say, Simon's point there raises a really, really important point, I think, for intermediaries on two fronts. One is that customer expectation that moving forward they will want that type of service from you, but it opens up something else on the lender front. So some lenders, we've started to see they've made really good progress around things like integration and streamlining that process. It's now down to intermediaries to get on board with that. Otherwise, things will slow down again. And that's my big concern. That the efficiencies are there, the time savings are there, but now there's a challenge almost being thrown back to the advisors to say, you need to start utilizing it. Otherwise, I think that kind of prioritization exercise will move back to where we were, where technology sits on the backlog because there's always something else.
Tony, to be fair, when we were younger, they were still chiseling mortgage applications on bits of stone. But just from a lender perspective, I'm just bullying you today. So it's the beginning of the month. But do you think that the technological advancements, a difficulty for you, and the conversation we had earlier on the podcast about this kind of independent reviewing, reading a story, this manual underwriting, adding technology could potentially take some of that away, surely?
No, technology is an enabler. You're never going to replace the human being in any customer-driven industry. Okay, so technology enables to get to that human, to get to that decision in factor quicker. Certainly in our market, as a specialist lender, I don't think I'll see in my lifetime an algorithm that can work out a specialist lending requirement for someone with 12 sets of accounts and XYZ. It's just not going to happen. So there's always going to be a requirement for it. But the driver is to get that data to that decision earlier. And to Nathan's point, he's spot on. The point I was going to say is, as lenders, particularly from our perspective, it's not a lack of desire to want to do it. It is the infrastructure and the time and the cost to do it, all in one go. We'd love to be there, but we just can't. You've got, as you say, you've got loads of redundant systems that need to talk to each other, and that is not easy. We are working at pace, working with, the likes of Nathan and 27 Tech and other providers to look at how we can drive forward that, integration. But it's a source of frustration for us because none of us want to be doing it how it's always been done. We want to do it differently, but it takes time. That's the challenges that we have.
we were going to talk about another article from Mortgage Finance Gazette, but I'm going to send the intermediaries there to have a look at it themselves, because it talks about, it was released back in April, so you'd have to look back. We could just search for technology in the UK mortgage industry, and it talks about AI, artificial intelligence, growth of artificial intelligence, and how these systems can improve the process. So do have a read of that, because it's actually quite interesting to see what they think is the old way of working and what they see with AI, how that process will work, right from the submission of an application right through to the funding of a mortgage, and how they think that's going to be improved with AI. So if you do have 5 minutes, Mortgage Finance Gazette, have a look for yourselves right back in April. We're going to jump to our next story, guys. So it's staying on this, but it's an evaluation tool. And again, we won't talk in detail because we've pretty much covered what I think we would say about this. But this is just talking about one element again. So, looking at this property fact, it's called this remote valuation tool. And again, Alex, you just mentioned, walking up and using AI. So you could go up to a house, scan it, it would give you a valuation. It would then give you somebody and say, these lenders would lend you on this, and these are the rates, and you want to pick one, and here you go, and you'll automatically submit your information for your phone, and boom, you've got an application in. This seems like step one, but is it going to be something that intermediaries will understand and will be able to get part of and understand what the client's saying? But is our clients really going to get that interest in this level of technology? Is that the future?
Depends on whether it gets them their outcomes quicker or easier, because that's what people want, isn't it? This is a real cliche, but no one really wants a mortgage. People want a house, or they want to refinance their mortgage to make it cheaper, so they've got more money and they're spending less interest. So any tech that gets people closer to those outcomes or makes it easier, people will follow. And this is true with advisors as well. Advisors will follow the path of least resistance, because that's natural human behavior. In terms of remote valuations, remote valuations aren't new. All that happened last year is that there's two types broadly. You've got desktop valuation, which is a trained valuer using secondary resources sat at his or her desk to come up with a valuation of that property. And then you've got AVMs, which are automated valuations, which use algorithms to come up with a value of that property. And they've been around for a long time. All that happened last year was that, for very obvious reasons, you couldn't go around anyone's house and have a look anymore. So what that did was create a scrabble for lenders who didn't use these things to get them implemented so they could keep supporting customers. And for those that already had them in place, they had to think about, how much risk do I want to take with these models, and how high can I go up the LTV curve in terms of lending with them. And that's got to be a good thing, because I think sometimes AVMs and remote valuations get a bit of a bad rep, but you have to remember that with a physical valuation as well, there's still a health warning on that. So a physical valuation generally comes with a 2.5% tolerance either way, and AVMs have a confidence interval which starts at A and goes down to D or E, and depending on how accurate the algorithm thinks it can be in terms of valuing that property. So there will never be I can't see a time where we would go completely to remote valuations, because if you're buying a house, you're going to want to have a look inside that house and see what kind of condition it's in, and all of those factors. So that there will always be a place for it. But do I see a world where remote valuations are used more often and more of the time? I think yes, because the remote valuation can happen instantly, and for lower risk, lower LTV customers, that is one of the things that unlocks an instant mortgage. So yeah, it will grow, but in small specialist worlds, so in commercial mortgages or buy to let, actually, where their use is a little bit lower, I think you will still want a person to go around and assess the condition of that property. So it's everything, as Tony said, you can't strip the human out of everything. And in fact, that isn't the right thing to do. We need to use the tech where the tech makes sense to enhance the client outcomes. Just blindly chucking tech at every solution will lead to the wrong outcomes, and that's where things go wrong.
I think the owners of Meta, who used to be Facebook, might disagree, because I was watching, actually, weirdly, just last night. I'm sure you've seen on TikTok the 15-second sales pattern for estate agents, so you can sell your house. You literally get a 15-second video on TikTok, and they will just walk you through the whole house, show you all the features. Yesterday, I was watching a video of an estate agent showing somebody around a live house that they had recorded on a special camera, and you could go around and view the home completely remotely. You were living in the environment. You had a headset on. You're walking around. I mean, it's a whole weird kind of future for me, but it is the future. Surely, Nathan, you want to say something there?
It kind of, so that whole scenario you've kind of talked through there is similar to how the market has talked about aggregators for years. So the fact that aggregators are there, they serve other markets, why can't you do a mortgage through it? For me, there's one key difference. It's the amount of money you're dealing with, which is a point Simon made earlier. If you're spending, £200 on your GI each year, if you get it slightly wrong, it's not going to make a huge amount of difference. If you get your mortgage wrong and it's 500 grand, that is going to make a huge amount of difference. And that's why I think having a human conversation, and importantly an intermediary, will always be key to the mortgage process.
So, Tony, we're not going to start seeing virtual reality intermediaries anytime soon then?
I don't know. I agree with Nathan. I just don't think robo advice has been around for a few years now, but it's smoke and mirrors. It's somebody in the background typing away. Even if you look at the best people doing it, it's not robo. So you can't get rid of human beings. We're our brains are far more complex than anything that can ever be built, and we only know that much about our own abilities through our brains. So there's a lot to do there. I think going back to the argument about remote valuations, I agree that it's very much a residential world, up to max 70% loan to value, because, as Alex said, these confidence factors, you don't want to push it further. But I think there is an opportunity for lenders who are brave to do it in a buy-to-let or a different kind of world and get that comfort. And I think that comfort will come over time. The confidence factor's at 70 at the moment because you've got statistical data that says 70 is the right figure. As you get more data, that will go up and up. So I think you will see more for more standard stuff. But I agree with a complex building and a complex situation, you need a human being to do it.
There is no AI that can emulate a human brain and human decision making.
It can just enable getting to that person quicker and enable the output from that person. So the problem with this with the current model is it goes into a time scale. It waits for someone to go out and value it. It comes back. It waits for them to upload it and type it out and then send it to the lender, who then sends it out to the broker. And that process is up to 10 days. If it can be done within 30 minutes of the surveyor being there and scanning something that does everything for you, that's where I think the innovation will come to get that outcome quicker.
And I think at the convenience of the customer as well. So that's why I liked what Alex was saying about the app. We like to operate 9 till 5:30 as an industry.
Yeah.
But customer circumstances have changed, where they don't necessarily work 9 till 5:30. So I think going back to technology being an enabler, how do we service these customers and meet their expectations outside of those hours? Mm-hmm. And enable them or give them the comfort that they can wait till 9 a.m. because we've managed them in the meantime.
Yeah.
Okay, so I'm going to put you all on the spot then. If we could introduce one bit of technology to the mortgage market now that will help with that speed up process, would just help make our jobs easier, that exists, what do you think it would be? Alex, you talked about your app, but if you were to pick one development, one technology development that needs a real boot on the bum and can be done, we've got the technology for it, but we don't have it yet, what would it be?
A single source of truth for ID and V. It's completely possible, but at the minute it still isn't there. ID and V is done about 5 times across the mortgage process. Yeah. It's paid for 5 times across the mortgage process by different parties. You're asking the customer 5 times to do the same thing. It should happen once right at the front end, either at the estate agent or at the intermediary advice stage, and that ID token should be passed through to the lender, to the conveyancer, all the way to the end.
I'll just come into that. I got it yesterday. There is a government-sponsored pilot for this going on at the moment. So I think that wish is going to become sooner rather than later. And I 100% endorse it because it just it's obvious.
It's a simple one. Nathan, have you got any thoughts on it?
So mine was going to be very, very similar to Alex's, but I'm going to take it even broader. Why can't we validate even more information earlier in the process? So things like we've talked around open banking as an industry for the last 3 years, which is kind of in that similar vein as ID&V. If we can validate this information up front via the advice conversation, why can't that just be used to power the application, to power the decision all the way through to completion? That there is too much repetition throughout the industry and ultimately completing of the same jobs.
Okay. Simon, come to you.
Mine's a bit of a cop out, to be honest, but the automated valuations, I think at Saffron we try and really push our service as best we can, and to try and narrow down the days it takes to get a mortgage, and it's almost outside of our hands to a certain extent, the valuation. So to try and speed that up would only improve our service as a lender. So a bit of a cop out there. Apologies.
Tony?
For me, it's open banking. It's the biggest source of frustration for me is that I still have to ask for bank statements and X, Y, Z, and that's the frustration. And it exists. It's just we haven't got the capacity and the capability yet to really embrace it. And I'd love to see it broadened to a broader scale of like company's house data. You get a confidence rating straight away from someone's account, so you don't have to look at them. It's just anything that speeds up. The data's there, it exists, someone has it. Let's just get everybody getting it and make the decisions a lot quicker. So that's the biggest thing for me.
It's an industry-wide challenge, but really interesting to get everyone's views on that because, it's important, and we all work in different areas with different things that we're interested in. So that's really interesting to hear. Our time is up, guys. This has been one of the most interesting we've ever done. Actually, getting your guys' opinion on technology was brilliant. And actually, we had quite a nice topic called Newsweek as well. So, Alex, Nathan, thank you so much for joining us. I hope you guys will join us on SFI Live at some point. We can see your faces,
Yes, please.
your voices. We're putting 2022 together at the moment. So before the end of the year, we'll have a plan of action. So we'd love to bring you guys in and get your opinions. So thank you so much for joining us. Really appreciate it. Simon, thank you. You did get to speak somewhere through that. Sorry, mate, but the guys have a joke. But Simon's back with us again, no doubt, in 2022. And will join us on SFI Live. And me and Tony will be live online on the 17th of November is our next one, where we're focusing very solely on first-time buyers. And we have a very exclusive opportunity for intermediaries to decide a little bit of the future and how we communicate through Saffron for intermediaries as part of that webinar. So we'd love you to be able to join that. And don't forget, that's CPD friendly. So you'll get CPD certificates after that. And then following that one, if you're listening a little bit later, it's the 15th of December, where you will get to meet the CEO of Saffron Building Society, who'll be joining us on SFI Live and Not So Live, apparently. So we'll be finding out more about that as December comes around. But thank you again, guys. Been much appreciated. This has been us. Do look out. If you've listened to this online, please connect to the series and it will update you every time we put a new monthly episode out. So just wherever you are. If you haven't got that opportunity, pop over to Spotify, Apple Podcasts or Google Podcasts. They'll give you the opportunity to follow the entire series. But I've been Jay Evans. This has been SFI Not So Live. Thank you very much and we'll see you next month.